Today we're going to break down one of the most interesting earnings reactions we've seen this season, Enova International. Now, on paper, they had an absolutely stellar quarter. But the market? Well, the market clearly wasn't impressed. So we're going to get into that exact puzzle. What happens when a company reports a huge beat, but the stock drops anyway?
So here's how we're going to tackle this. First up, we'll look at the numbers versus that weird market reaction. Then we'll get into management's super bullish story, including their massive plan to buy Grasshopper Bank. After that, we'll try to figure out what's making the markets so nervous. And to wrap it all up, we'll give you our take on what to expect next and our official rating.
All right, let's jump right into the heart of the matter. This quarter was a textbook case of a disconnect. The company delivered, big time, but investors, they hit the sell button. So the big question is, why?
Check this out. This is the whole conflict right here. Enova's adjusted earnings per share came in a full 8% higher than Wall Street expected. That's a solid beat. But the reaction? The stock dropped more than 2% after hours. I mean, this is the kind of thing that just makes you go, huh?
And it wasn't just a one-off earnings beat. The numbers were strong pretty much everywhere you looked. They hit a record $839 million in revenue. Adjusted EPS was a strong $3.46, and their adjusted EBITDA landed at $211 million, which is up a massive 21% from last year. Seriously, by any normal standard, this was a fantastic quarter.
So with numbers like that, you'd expect management to be confident, and they were. They came out swinging on the earnings call. Their whole story was about strength, saying they've got considerable momentum heading into the new year. So let's see what's got them so optimistic.
And they didn't just talk the talk, they backed it up with some seriously strong guidance for 2026. They're telling investors to expect originations to grow around 15%, with revenue growing right along with it. But here's the kicker, the bottom line. They're guiding for adjusted EPS growth of at least 20%. That is a huge vote of confidence in their own business.
And this confidence? It seems to be built on rock-solid ground. Operationally, the business is just firing on all cylinders. Their loans to small and medium businesses, the SMB part of their world, is exploding, up a crazy 48% year over year. At the same time, their credit quality is holding steady, and their consumer side really picked up steam toward the end of the year. It's just a picture of a really healthy core business.
But believe it or not, the story gets even bigger. The most important thing they talked about wasn't really the last quarter or even the guidance for next year. It was this absolutely transformative deal they've made to buy a company called Grasshopper Bank.
So what's the big deal with this deal? Well, the logic is actually pretty simple, but it's incredibly powerful. When they buy Grasshopper, Enova gets a national bank charter. And that is the whole ballgame. It basically cuts through a ton of red tape and, more importantly, it lets them start lending in new states they've been locked out of. It just unlocks this huge potential for growth and cost savings.
And the financial payoff? Oh, it's huge! Management put a jaw-dropping number on the table. They said that once this deal is done and they get everything running smoothly, it's going to boost their adjusted earnings per share by more than 25%. For a company this size, that's just a massive, game-changing number. It's really the heart of the long-term story for the bulls.
Okay, so let's recap. We've got a great quarter, really strong guidance, and this transformative deal on the horizon. Which brings us right back to that nagging question, if everything is so great, why on earth did the stock fall? Let's try to get inside the market's head.
See, the market is always looking ahead. It's not just reacting to last quarter's great numbers, it's trying to price in what could go wrong down the road. So what exactly is spooking investors here?
Sometimes the devil really is in the details. Take a look at their guidance for what they call net revenue margin. In Q4, they hit a solid 60%. But for the next quarter, they guided to a range of 55 to 60%. Now, it seems like a tiny thing, but that lower end of the range is a little hint that things could be a bit soft in the short term, and that's enough to make some investors pretty nervous.
And context here is everything. You have to remember, this stock wasn't exactly a sleeper coming into this report. It had been on an incredible tear, up over 30% in just 3 months and over 40% for the year. This is a textbook setup for what we call a sell the news event. Basically, all the good news was already baked into the price, so investors decided to take their profits and run, no matter how good the report was.
So when you put all these pieces together, the market's hesitation starts to make a lot more sense. First, you've got huge execution risk. Integrating a whole bank is not easy. Second, the deal isn't even done yet. It needs regulatory approval and probably won't close until late 2026. Add in that slightly softer guidance for next quarter and a stock price that's already had a huge run, and you can see why people are tapping the brakes.
All right, let's put it all together. We've heard the bull case and the bear case. So, balancing the company's strong performance against the market's very real worries, what's our final takeaway? What's our official rating on the stock going forward?
Now, before I give you the rating, I just want to be super clear on what we mean. A market perform rating means we think the stock will probably perform about the same as the overall market or its direct competitors over the next year. Not way better and not way worse. Just in line.
So, with all the facts on the table, our rating on Enova International is market perform. The company itself is solid, but the investment story, well, that's changed.
Here's the bottom line. Enova has turned into what we call a show-me story. The market is basically saying, great plan, now prove you can do it. The fantastic performance of their main business seems fully baked into the stock price after that huge run. And that amazing 25% earnings boost from the Grasshopper deal? It's powerful for sure, but it's a story for late 2026 or beyond. So for now, we think the stock is going to be driven less by great quarterly reports and more by news about that deal getting done. The question has changed from, is this a good company, to, can they pull off this really complex, game-changing acquisition?
And of course, as always, just a quick reminder that this analysis is for informational purposes only. This is not financial advice.